Today in the podcast, we are continuing our two-part series on basically the age pension. Last episode, go back and watch that first. It's on YouTube, it's on the podcast. We talk kind of pre-application and some of the structural things and the FIS officer and what they can do for you and a heap of eligibility requirements. But today we're going to talk about, once you're on the age pension, whether that's $1 a fortnight or the full rack rate, what do you need to do while on? Can you work on the age pension? We'll talk about gifting. We'll dig into the deeming, travelling on the age pension. Can I skip the country for 3 years and still get my delicious cash? Maybe not. And we might round it out with some combination of the superannuation and age pension, how they work together. Today I am again joined by Justin Bott. He is a Community Information Officer.
That's the one.
At Services Australia. Welcome back for another go.
Thank you so much for having me back.
My name is Glen James. Let's get on with the show right now.
This is a podcast that will help you plan and execute one of the biggest moments in your life. That's retirement. You'll learn how to set up your finances in a way that benefits you, your lifestyle goals, and keeps you in the know within this complex world of money and investing. Your host is Glen James, former financial advisor, author, and host of the popular Money, Money, Money podcast. Glen is joined by experts in various fields around the topic of retirement in Australia. Any advice in this podcast is of a general nature. Full details are in the show notes of this episode. You only retire once, so retire right.
All right, Justin, we talked about the preparation and all before the age pension. What people need to do once they're locked in, dialed in, and on the pension, receiving payments each fortnight.
Yeah, I think the what we have is a myth. It's a misunderstanding that a lot of people have, but it's such a big misunderstanding. It's sort of moved to the myth status. And the idea behind this myth is your government. I've lodged an application with you. Your government, you know everything. So it's like if I sit down in front of a customer service officer in a Centrelink office, Service Australia office, and you got me doing it, Service Australia office, and I sit down in front of one of the customer service officers, they can just hit Alt-Tab on their computer and they can see the present balance of my name your bank account. I don't need to tell you because you can see everything because that's what government can do. And the answer is actually, no, we can't. We absolutely cannot do that. So if you are receiving a payment from Services Australia, then part of your obligations on that payment is to tell us about any change of your circumstances within 14 days.
Right.
So if you don't tell us about change of your circumstances within 14 days, what can happen is if you get payments you're not actually eligible for, then we may have to ask for those payments to come back. So we need you to pay the money we gave you that we shouldn't have given you in the first place because you didn't tell us that things have changed.
Just a random thing, two things there. What's an example of change of circumstances?
That's great. I'm really glad you asked that question. That is an awesome question. So when you get payments from us, we're going to send you letters. And that might be hard copy letters that actually go in your letterbox, or it could be the online ones that go in your MyGov digital inbox. Have a look at the back of those letters because often you will find a quite comprehensive list of the things that you need to tell us about. So the big tip is to read that list because it's going to be on there. It's going to be quite comprehensive. But what we're talking about here is I've changed address is a massive one. I've changed my marital status. I'm now single or I'm now a member of a couple. I've going overseas. I've started work. I've changed jobs. I've become self-employed.
Okay, on that, going overseas, if you're doing a 2-week holiday to Thailand, not a big deal?
2 weeks is fine. You
Okay.
don't actually need to let us know. If it's 6 weeks or less, you don't need to let us know.
Awesome, continue.
We will. So we'll talk about that a little bit more later. Or I should say, in saying that, that's the age pension rules. For 2 weeks, you don't need to let us know. Different payments, different rules. The other one is changes to your income and assets. So significant changes or changes to your bank balances, changes to your share portfolio, those sorts of things. They're the sorts of things that we need to know about. Yeah.
Yeah, cool. And then just you touched on it's important to update because if, for example, you got an inheritance, landed in your bank account, 5 months went on, because you may be grieving, which is totally human, and please grieve and all that stuff. And oh crap, we've got to get around to tell Centrelink we've got an extra 800,000 or 500 or 200. If there was an overpayment, and I'll just make a number up of $3,000 over that 6-month period, how militant is your army? Are they saying, we want the money back right now, or can you work a payment plan? Can you offset that each fortnight for the next month? How hectic are you?
It is actually designed to work with you. And certainly if you're already if you continue to be eligible for a payment from us, then you can set payment plans and part of that payment, and you can change that, and that's all the sort of thing you can do.
Oh, but if it knocks you off,
if you're not on a payment, then either you we'll send you a letter that will encourage you to pay it off completely, but you can still come up with payment arrangements. It's just the basic message is talk to us. If you have a debt, talk to us. And it doesn't mean. Often I get people worrying about it. There's some implications of, criminal. I've done something criminal. It's not about doing something criminal. It's about I just got money I wasn't supposed to, and I just need to pay that money back. Now, of course, that's an entirely different story. If you're deliberately trying to commit fraud, then you are doing something criminal, and there's all sorts of different procedures.
Not much
in
grace
place.
when you're blatantly breaking the law.
That's right. But if it's just a simple issue of, I've received money I shouldn't, and if it's still sitting in my bank account, I could just pay it back. Or if I don't have it directly to do that, can come up with an arrangement, but I need to speak to Services Australia first. Yeah. Now, on your scenario, the one that you were just giving, just a couple of points on an inheritance while we're just there. It's not your money until it's actively been distributed to you.
Yeah, so if it's sitting in the estate with your name on it, that's cute. It's not yours yet.
That's correct. The only time that we would hesitate on that one is if you are actively trying to keep it in the estate to avoid having it hit your bank account, and you're starting to really push that out, and we start going, hang on a second. Now,
please explain.
Yes, why haven't you received the money? It is yours. But if you're just waiting for a normal inheritance, they can take a while. And although you might know the exact figure that's coming, until it's in your bank account, it's not your money. You don't need to tell us about it because you haven't got it yet. Yeah. But then when you do get it, make sure you tell us within 14 days. If it removes eligibility, then you are eligible to the pension up until that point. You're not eligible once the money's yours. Tell us within 14 days to avoid the debt happening. If you do keep getting payments, then just simply put them somewhere. Just keep them in a little account, and so where the debt goes, you just pay that money back really quickly.
Okay, question. We've talked about overpayments. For example, we had $200,000 cash that was in a bank account that was accessible to Centrelink. We ended up finally renovating the kitchen, the bathroom, and we've spent $200,000 on the house, which we've moved that $200,000 from a deemed asset into a not deemed
into the family home.
Into the family home, effectively.
Yep.
And then life happens, and oh crap, we need to update Centrelink. It's been more than 14 days. They owe us money now. Will they backdate to the date? Why are you shaking your head? Let me finish. Will they backdate to the date when the money left the account into the home, or will they just adjust it going forward?
They will only adjust going forward.
You sound like the ATO. If we owe you money, we won't tell you that much, but if you...
Yeah, so if you don't, that's the other thing about telling us within 14 days, because if your rate increases, but you don't let us know within 14 days, then that's just money you've missed out on. So just keep to the 14-day rule, and you'll be giving yourself covered for that. Yeah.
So big change of circumstances. If in doubt, ask.
Yes, simply get in contact with us and ask and tell us what's going on. We can't work with things that are going to happen.
No.
So if you know in a month's time that you're going to be spending, because that's the plan says that I've got a prepayment and it's going to be coming due on
out of the builder's
Yep, and I know on
invoice.
the 1st of August that I'm going to pay that money, and it's going to be $15,000 or $30,000 or whatever it might be. Can I tell you now on the 1st of July? You can't.
Yeah.
We can only act after it's occurred. So as long as you tell us once the money's gone, get on the phone, but better still do it online. That's the sort of thing that's why online is so much better. It's so much easier to let us know about those changes. So do it online within the 14 days and you're getting your bases covered.
Back to the inheritance, and I'll say it now and we might pin it until the deeming section, but if you inherited a house worth 800 grand, in theory, it's not different if you receive the 800,000 in cash, is it?
The asset value is the same.
Yes.
It's only the income will
Yes.
be different.
Yeah. Okay. We'll put a pin in it and we'll come back to it in deeming. Okay. We touched on it and teased it a little bit last episode, but once we're on the pension, let's again talk about working.
Sure.
And I think most social studies and health studies and all that stuff, there is so much linked to work and doing stuff. It's either the sense of purpose, the sense of dignity, the sense of community, all that stuff. So I want to say out loud, if you are receiving an age pension, don't think that you can't work.
Absolutely not.
And this is the crazy thing,
Yeah.
even if you did work and receive money and your pension decreased $20 a week, that's still okay.
Yes.
Because remember, if my circumstances change or I stop working, I need to tell them within 14 days for the Mercury and Venus to realign.
Well, it's in some ways it's actually even easier than that because
Right.
if you're on any payments from us and you're working, then generally speaking, we're getting you to report every fortnight the income that you've earned. And your pension
That does sound annoying though.
But it's an online process.
Okay.
So it's a very easy, or you can use a self-service phone number that we have where you just ring into the computer.
Sounds even more
talk
annoying.
about the wage.
Yeah.
But you're reporting your income every fortnight. And what that means is that your pension is being accurately reflected for the income that you've earned, which means that if you didn't actually work in that fortnight, you tell us that your income is zero, your pension will be adjusted.
Okay,
to
so if I had
reflect
a big fortnight and I may have been working at the AEC for the election and it was a seat in Sydney, it took a month to count.
To do all the counting, yeah.
If I happen to, hey, can you do 5 days straight for 2 weeks of 5 days reporting it? Is it flexible enough that if you really generated money over that fortnight, the next fortnight the payment would go to zero, and the next fortnight when it's adjusted it would increase back? How responsive is it?
It's brilliantly responsive. So you can actually receive the pension at zero rate for quite a significant period of time, which means that you're earning your income. The income that you're earning is so high that the pension actually can't be payable. We don't just cancel you at that point.
Yeah, but you're still logged in and connected to the system.
You are. So you're still current on a pension. We're just not paying you any pension. And you report next fortnight, and it might be a few fortnights where you're still earning too much and the pension is paid at zero rate. Stop that work or it goes back down again, we pay you $20 of pension and you weren't cancelled the whole time. You just keep reporting.
Is there a sunset clause of if you have 5 fortnights at zero pension, they'll go, hey, are we stopping this? Or are you just always on?
No, there is a sunset clause, but it is, forgive me because it's just moved. It used to be 12 weeks.
Right.
I think it's now 26 weeks, but you forgive me if I get that wrong, where you can be at zero rate before the pension cancels. But then what happens is that you actually have 2 years from that point
to reactivate
it, and you're eligible for your pension concession card for that 2-year period of time. So it's not an issue of reapplying and having to go through the whole reapplying for the pension process. It's actually much easier. It's more just proving that the income has stopped and maybe doing a little bit of an update of your income and assets details to then get the payment started again. So it's if your income is too high for the pension to be payable, you'll notice it will actually be quite a while before the pension cancels. That's fine. That's what's supposed to happen. And then even though the pension's cancelled, you still keep your pensioner concession card for 2 years from that date. And if the work stops before then, you're back on the pension, whatever rate it is, pension concession card stays because you got eligibility for it again.
What's the amount that I can earn up to before any pension is reduced?
All right, so this is based on 2 factors, and we're talking here about income from work. So the first thing that we're looking at is what's known as the income-free area. So the income-free area is the amount that you can earn from any source of income, whether it be wages, whether it be interest from deemed accounts, whether it be rental property income. It's the amount that you can earn before the pension starts reducing in the first place. If I'm a single person, that figure is $218 a fortnight. If I'm a member of a couple, it's $380 a fortnight of combined income, where my income is not enough to affect the rate of pension. On top of that is a special rule for people that are over age pension age, whether you're on an age pension, disability support pension, carer payment, if you're over age pension age, which is 67, and still receiving income from wages or eligible types of self-employment, where the work bonus comes into play.
Yeah, so what is the work bonus?
All right, so every fortnight that you're earning an income from wages or eligible self-employment, we will not count the first $300 a fortnight from that wage.
Whether you're single or coupled?
Single or coupled. It's the person earning the wage. So if a member of the couple were both over age pension age, both working, that's $300 each. So the first $300.
So you could do 5 hours a week pretty much.
Yes.
Or cook it however you want.
Yeah. So the first $300 a fortnight is not going to count. Doesn't count to anything. So, and then you got the income-free area on top of that. So if it was wages, in effect, it's $518 for a single person, or $680, or even $980 for members of a couple, before the income starts to potentially affect the pension. Now, the nice thing about the work bonus is, first of all, it's automatic. So you don't have to do any of the maths. We do it all for you. Second thing that's good about the work bonus is this thing called the work bonus balance. Now, the work bonus balance is, in effect, it's a wage offset where we can build up this work bonus to not pay attention to future wages that you might be earning. And everybody, if they apply for a pension, now starts with a work bonus balance of $4,000 right off the bat, which means that if I apply for a pension tomorrow, I can earn up to $4,000 and none of that income is actually going to count towards my pension.
Now, is that per calendar year or financial year or pension year or lunar
year? It's not even that. It's flowing.
Right.
So every fortnight that I'm not earning $300 or either some or all of that $300, then I'm adding to my work bonus balance until it grows to a maximum of $11,800. And once it's at that maximum, it won't go any further. And it just sits there. And if I'm not working, it will sit there for the rest of my pension life. But if at some point I do start working, like I just worked at the recent election, then we're going to look at that $300 a fortnight. Then anything over the $300 a fortnight that you've earned, we're going to offset against your work bonus balance. And we've got to draw that work bonus balance down to zero. And it's only when you've used up all of the work bonus balance that you start having an impact on the pension. Now, I'm going to give you an example to explain it because it's numbers and it makes it easier. So I got a guy named Ray. He's been off a pension. He's been on a pension for 6 months, hasn't earned anything, and he's built up his work bonus balance to about $7,000. He then starts earning at $750 a fortnight. So he started a part-time job, earning $750 a fortnight. He reports his first income to us. Automatically, we take off the $300 that we do every fortnight. So the $750, we take out $300, we don't look at that. We've now got $450 of assessable income. We then take that off his work bonus balance. So the $7,000 becomes $6,550. All of his wage has been absorbed by his work bonus balance. There's nothing left over. His pension is unchanged. So he earned $750 in his pocket with no change at all to his rate of pension. And if he kept earning $750, it would take somewhere in the vicinity of 13 fortnights, so more than half a year, before he eventually drew his work bonus balance down to zero and he started to see a change in his pension rate. So if I was doing just 4 weeks with an election and I had the full work bonus balance of $11,800, I report my income, but my pension's unchanged. My work bonus balance starts going down. I stop work. The $300 starts getting added back up again. It starts building back up again until it reaches the maximum of $11,800.
Okay, I think this is really good information, and I think it just takes a lot of that misconception and fear, particularly, if you stop working at age 67 and you're like, oh, I'm a bit bored, or, I think I need to get back out there. I'm in good health, physically or mentally even. Yeah, go on drive the Kodo bus, Thursdays of a week, or don't be afraid to earn money.
Yeah, absolutely.
And let the cards fall as they may.
Because remember when we talked in the last episode about the cutoff point under the income test. So if I'm a single person That's $65,000. With the work bonus, that actually goes to 73 grand. So I can earn $73,000 before the pension stops altogether. Now, we talked a bit last time about the full rate of age pension for a single person is about $29,000. I can earn $73,000 worth of wages and that's at only that point that the pension stops. Now, granted, it's been shrinking a lot before that point, but I still get that. So, earnings potentially up to $73,000, and I'm missing out on, I don't get all of $29,000 worth of pension, but I've got $70,000 or so worth of wages. You're definitely better off if you can work. The important message here is if you want to work. This is a completely voluntary thing. So if this is something that you who are over age pension age want to do, then knock yourself out. If it gets to a point where your pension is earning so much that it eventually cancels in a very long time, which we've already talked about, then all right, I've earned so much the pension stops. If that stops within 2 years, I can get back on again really, really easily, and we can just start the process all over.
Okay, a couple of things. Generally speaking, if someone went to get a casual job and they're on a casual roster and they are an employee, when they have their tax file number declaration, they would not claim the tax-free threshold, would they?
From their employee, they probably would, I'm guessing. I mean, this is a tax question more than mine.
Yeah, but if you think, so if you were receiving the full pension as a single, and we'll just call it, what did we say before?
29 grand.
30 grand, call it 30 grand a year.
Yep.
Any income, like that money, it's tax-free, but it's higher than the tax-free threshold.
The money is not tax-free.
No, sorry. The Centrelink, I think what I'm saying is any money you earn as far as the ATO is concerned, you're not starting with your casual job at zero.
No, you're not.
So, and this is where you probably should get some personal advice on what to tick.
Yes.
Because it may mean that I have to pay the higher tax rate for that casual job and not claim the first $19,000 or whatever the tax-free threshold is. What is that, by the way?
Well, see, that was what I was going to point out because we're now talking older Australians.
Yes.
So older Australians have a special tax world that younger Australians do not have access to called the Senior Australian and Pensioner Tax Offset.
SOs.
And although the age pension is a taxable income, the Senior Australian and Pensioner Tax Offset, it actually means that it's higher than that threshold. So if and not everything that you get every fortnight is taxable as well. So when you get your fortnightly payment, there's the age pension, which is a taxable payment, but you also get supplements on top of that. You don't see that. You just see a fixed amount that hits your bank account.
Yeah, but the offset, it's from what I understand, and I know enough to be dangerous, you run through the same tax bracket, but you get the SAPTO offset applied.
Yep.
And the maximum offset for a single person is $2,230.
From memory, that's about the equivalent of $34,000 in taxable income.
Yeah, so because how it would work, it would be that it basically, when it all washes up, they're not going to ever have it. So if you are receiving the age pension, that you're paying tax.
No.
Unless it's from income or investment income.
No, so because the pension's a taxable income. So from tax purposes, they're just going to add that with the rest of your taxable income and work out what your tax rate's going to be. So when we say that the pension is, you don't pay tax on the pension, what we're actually saying is that the pension itself is not enough
to pay tax.
On. So it's a taxable income. It's a difference between having a taxable income and actually having to pay tax.
Yes, and I think we both were coming at it from a different angle.
But agree.
We agree that if you had no other income other than the pension, the way the Seniors and Pension Tax Offset or SAPTO, SAPTO works is the effective you don't pay tax.
Correct.
However,
So what I would say is that you're quite right. If I'm on a part rate pension and I'm earning wages, then the pension is a taxable income of which I haven't been paying any tax on.
That's right.
So I then have a couple of choices. And this is why I would say you probably say for the wage, but again, talk to your professionals. You probably would say for the wage, I'll take the deduction on that one. You can actually go to Services Australia and ask for us to deduct some of your pension to go to the Australian Taxation Office. So you can set up your own tax deductions off your pension if that's something that you want to do. Now, first thing I would say is there's 3 tips about this one. Number 1, we're not going to tell you how much. So you'll get no guidance from us about what you think is a reasonable amount. Number 2, it's completely voluntary. You can start it and stop it whenever you want. It's the sort of thing you can do with your MyGov account linked to your Centrelink record. So it's something that you could do if you wanted to. Number 3, make sure you actually even have to do it in the first place. And that's where you can go to your MyGov website, so my.gov.au, and look up tax time. You'll actually find, and we've now passed the 1st of July,
Yes.
so it'll be there now. The information will be there. You'll be able to get links to tools to things like the ATO's Do I Need to Lodge a Tax Return tool. That'll give you an idea of the sort of tax that you would pay, because you are right in saying that if my pension is a taxable income and I've got wages, and it might not even be that I was earning while I was on a pension, but if I retired 1st of January, then I've got 6 months worth of wages in this financial year and then 6 months worth of pension. The wage for the first 6 months plus the pension alone can push me into potentially having to pay tax on some of that pension.
Yep.
If I choose to then put some of that money aside for the ATO, then that's just to reduce the bill. Now, worst case scenario, if you get it wrong or you get too much tax taken out of your wages because you picked the other way, you're going to be lodging a tax return anyway. The ATO is going to work out how much tax you should have paid against the tax that you did pay and reimburse you for the money that you didn't have to pay in the first place. The only problem really realistically with getting it wrong is that you've given the ATO a little bit of money of your money that they didn't need to have, and then you've got to wait 6 months to a year before you can get that money back. So, I mean, that's the ultimate downside.
Yeah, I think it's just a flag. Whatever way you cook it, any income above your age pension, as far as the ATO is concerned, comes online for tax.
Any taxable income. So
Yes.
I want to just make sure we don't count things like your account-based pensions. Your
Oh, yes, sorry.
non-taxable income, yeah.
Yes.
Yeah, so
any investment income or
Yes.
earned income.
Yep.
We know that if you set up a superannuation pension, any payments you receive are tax-free.
Yep.
So, again, all this to say, don't fall into the trap where, I would like to work a day a week to get out there, but this is all too hard. No, please do that. Let the cards fall as they may.
Yep.
Because for you as a person, if you're out there being active and engaging with society and you've got something to do, absolutely go to work.
Yeah, and not only that, because yes, you're quite right. The huge amount of research and the advantages of interacting with other human beings and getting the grey cells to be working as you're doing that extra work. But also, the way the pension income test works is very advantageous with that work bonus, and the way the tax system works is actually advantageous for older Australians as well. So there's a lot going for you to say that this is a good idea, and you're in a better financial position and a better cash in hand position if you do choose to do the work.
Yeah, so I'm just on a tax calculation website, and just as a real time, I've just put in, so what was the current single person per fortnight? 1106?
No, it's 1149.
1149. So if we do 1149 times 26, that gives us 29,874. Now, if we did the odd part-time election thing and throughout the year we earned an extra $5,000
Yep.
or $100 a week.
Yep, and with the work bonus, we didn't have our pension reduced.
That's
because
right.
we still got the maximum
So pension stays the same.
Yep.
We've done $100 a week shift somewhere. If I go to the normal tax calculator and put $35,000 in there, because we've got our Centrelink age pension
Yep.
and our $5,126 of gross income,
Yep.
and I'm eligible for the SAPTO, the total tax that I pay is zero.
Yep.
Because I've qualified for the SAPTO and also the low income tax offset.
Yes.
So all this to say, in your mind, if you wanted to do a day a week, you're probably fine in terms of tax and in terms of
Payment.
pension
Yep,
payment.
for sure.
And that, speak with the accountant, but I might be right, I may claim the tax-free threshold on the TFN declaration. But I'll leave that for you and your accountant.
Yes,
we will move along rapidly.
That's in the advice realm. We'll stay away from that.
But
one for sure.
but the thing is, that declaration, you actually have to, by law, make it a legal declaration. So we'll move along. So lots there. Hey, did they ditch the thing where if you don't apply for the pension when you're eligible later, you get the pension bonus. Is that still around?
That's not around any longer.
Okay.
There are still, that's a long time conversation.
Yeah, I know, I'm old.
There are still some people that are registered and on that system.
Yes.
I had an 80-year-old once apply. She'd been working, at that point it was almost 20 years beyond age pension age, and her bonus was going to be fantastic.
But that shuffle was this work balance and the threshold here, wasn't it? So it was more of a real-time thing.
They introduced the work bonus as a consequence to say that the wages are just going to have less of an impact than they would have otherwise, for sure.
All right, we'll take a quick break. When we get back, we're going to cover gifting and deeming and get into some more trouble. We'll be right back after this.
If you're after personal financial advice, don't get it from a podcast. If you would like help based on your own personal situation, head over to retireright.com.au, click Get Help, and we'd be happy to introduce you to one of our trusted professionals. Our panel of vetted financial advisors and mortgage brokers work with people all over Australia, so they can connect with you wherever you are. That's retireright.com.au and click Get Help.
Alrighty, we're back. You ready to go after that big long break?
Oh, we're absolutely ready to roll. Let's knock them over.
In the studio, there was probably about a 3-second break. Okay, let's talk gifting. I didn't mention it in the first episode, but part of the planning before pension, you do actually have to consider gifting. So talk to us about gifting 101. Yep. And secondly, can I have some money as a gift?
No, is the answer. A lot of people will come and the question they're asked is, what am I allowed to give? And the answer is actually you're allowed to give whatever you like. There's no law in Australia that stops one person giving another money to another individual or a company or a volunteer arrangement or whatever it is.
And I'll just myth bust as well. There is no gift tax in Australia.
Right. And then when I mean that's exactly right. So nothing to stop you. The issue is just don't expect that Services Australia is going to acknowledge you don't have all that money anymore, which is sort of the best way that I can frame it. And when we're looking at gifting, again, when you apply for a pension, we're actually going to ask, have you gifted any money in the 5 years before you applied for a pension, which is important in the concept of what we're going to talk about. So when a person comes to me and says, what am I allowed to gift? The answer is, well, anything you like. But the rules for Services Australia are, we will recognise gifts of up to $10,000 in a single financial year, but no more than $30,000 over a rolling 5-year period. So if I decide to give $10,000 away to you today, then it's a new financial year 25. I can't believe it's a new financial year 25.
I know.
Anyway, it's a new financial year 25.
Happy
26.
New Year.
Yeah, that's right. New financial year, we'll say, all right, you don't have that $10,000 any longer. We'll acknowledge your bank accounts have been reduced by $10,000 and that's done. I can also give $6,000 this year, $6,000 a year after, $6,000, it's less than $10,000 in any single financial year, less than $30,000 over a rolling 5-year period. Any money that I give away that's over these figures, Services Australia is basically going to pretend I've still got it. And that's where the gifting rules come into play. So any excess gift over those gifting-free areas, we're going to pretend you've still got that money. We're going to pretend it's sitting in a bank account like any other normal bank account. It's a deemed financial asset like all the other deemed financial assets, and it's going to sit there for 5 years. And it's only after 5 years that we will actually say that you don't have that money any longer and we'll acknowledge that the money is gone. So as an example, I have $100,000 in the bank and I decide that I want to help out my daughter and I'm going to give her $50,000. Services Australia will reduce that bank account from $100,000 to $50,000 because it's gone down. We'll acknowledge that you've given your daughter $10,000 and we won't count that. We will then create a pretend bank account with $40,000 in it and we'll keep that pretend bank account for the next 5 years. So in effect, I had $100,000 in the bank. Now I've got $90,000 in the bank, and that $90,000 is going to stay on my record for the next 5 years. If I am a part rate pensioner, then the reduction in those financial assets is going to reduce the assets that I have. It's going to reduce the interest that I have.
Oops, something just fell in the studio. It's just the ghost.
So if I'm a part rate pensioner, my assets will go down, my income will go down, my rate of pension will increase. Because I don't have the $10,000, not the $50,000, just the 10. and it'll stay acknowledging that for the next 5 years. If I'm a full rate pensioner, nothing will change because we're already paying the most that we possibly can pay you. So what I would say to people that are considering gifting is that if you have the resources and if there's a person in need and if you understand what it's going to mean for not just your pension, but the loss of access to that capital, the loss of interest that money in the bank would have been able to generate, there's money I can't play with any longer, that's income I can't get any longer. I take all that into account and I still acknowledge that the most important thing is to look after my daughter with $50,000, then knock yourself out. It is absolutely your money and you have the absolute right to do that. Just don't expect Services Australia to come along and say, well, your bank balance is now $50,000, we'll pay you that much at an increased rate of pension.
And in terms of the planning, if you are significantly established and you are 60 years old, make sure if you're going to gift money and you want to gift over that 30,000 threshold, maybe get all your gifting done to your adult spawn by the time you're 62.
From our rules, we don't pay any attention to gifting that occurs before 5 years before you turn age pension age. And if you gift up to within that 5 years, it's only going to affect you for how much of the 5 years
That's
is
right.
left.
So even if you did gift at age 63,
it'd only be 1 year left.
1 year of that asset. Now, what I'm actually going to do, I'm going to just record this because I was just thinking, and by record this, I mean just leave the camera on me. We've talked a lot about gifting and the pension. I was thinking I'm going to share this on Instagram. With the current crisis in Australia with young people struggling to get into houses, we've got an ageing population, we've got a lot of boomers that have significant wealth and they are receiving some age pension. One of the psychological thresholds that really get people is this gifting amount. So I want to put the challenge out there to Katie Gallagher and her team to run up the flagpole to Jim Chalmers. So next budget, can we do the numbers on increasing these gift thresholds, even doubling them? $60,000 over 5 years, $20,000 a year to help people give money to the next generation to get it moving. That's the challenge that I want to put out there because I have not seen these gifting rates changed in a long time. So that's the challenge. Share this around. We need to get the money moving into the next generation if it's there because people are scared that, if I give $31,000, I'm going to lose my pension and all that. Well, you'll lose a little bit, but you'll still be okay. But what about we look at increasing this gift amount without impacting the age pension? That's my challenge.
Now, my comeback is that idea of I'm going to lose my pension because I'm gifting. And in most cases, it's not because the gift has already come from an existing asset. It's not a new asset. So in the example that we had beforehand, it was a $100,000. I've then gifted $50,000 out of it. My new asset is not $100,000 plus the $40,000 extra. It's the reduced bank account plus the $40,000. It was $100,000. It's only $90,000. The big issue comes when I gift from something that was a previously exempt asset, like either I've taken the money out of a super fund like my partner's super fund.
Downsize the home or whatever.
Or I've taken a reverse mortgage and used the money from a reverse mortgage to help out the family. That's something new, something we weren't looking at before, and now I've added to my existing resources. In most cases, if I'm gifting money that I already had, that Services Australia was already counting, I'm just going to look at an increase in my pension rate. Now, the problem is that the increase in the pension rate is not going to compare with the amount that I've gifted. So the most, if I hand over $10,000, again, with the idea of gifting to improve my pension, we've talked about gifting to look after the family, knock yourself out. If the motivation of gifting is just solely to improve pension eligibility.
Yeah, showstopper, go away.
Yeah. Because, yes, my pension rate has gone up, but it's going to take somewhere in the vicinity of 13 years to just recoup the $10,000 I gave away in the first place.
Yeah.
So motivation is always important.
Yeah, and I think it is more of that psychological thing. So if we do sell the family home and we've put some downsizer contributions into super, oh, we're about to retire next year and get age pension. Oh, no, we won't help the kids. We'll wait till we die. No, they need the money now. You know, if you've got more money than God with your house sale, let's at least try and get the money flowing to help the next generation. And I think increasing the gift threshold may just help on a psychological level.
The big concern I've had, because and it's not disagreeing with the premise, it's the idea of, unfortunately, and I know we're not going there, but it's elder abuse.
100% agree.
So, because I have seen people just strap their cash to look after the kids and they're left with nothing. And not understanding the gifting rules, not only left with nothing, but not eligible for anything from us either, because we assume that they've still got these massive assets for 5 years. So if this is, again, the sort of thing that you can talk to the Financial Information Service about, certainly if you're thinking big money for big reasons, then talk about the Financial Information Service. I'm going to put another little caveat in there, in that if you've got somebody with a severe disability, so there is another asset, a special rule that exists for if you've got a child that has a severe disability and you're really worried about how we're going to look after this child after we're gone, we have something called a special disability trust. And a special disability trust is a rule that allows you to put quite a significant amount of money into a trust structure. It's a family trust structure under very strict conditions, solely for the purpose of providing for a person with severe disability. So it's not a gift, is the really important part. Normally, if I put money into a family trust to look after the kids, it's just a gift. I've used the family trust as a way to hide it, but it's a gift. In this special disability trust arrangement, it's not treated as a gift. So if you do have somebody that's got a severe disability and you are really worried about how to financially manage their future when you're not going to be around any longer, then absolutely look at our website for the Special Disability Trust and absolutely call the Financial Information Service, because we can help explain what those rules are. Because there's a real need and you got the ability, and there's can be real benefits for you.
Yeah, and I think just bookending on that financial abuse thing, it is real and it is serious. Maybe on this gifting thing, because I don't know, because I run this podcast and I see all these people in their 60s with all this money, and I see all this generation of people in their 20s and 30s that can't get into a housing market and they don't want to give the money because they don't want to mess with Centrelink and all that. Can we have some type of rule where you can gift a once-off lifetime $100,000, or you can stick to a rolling whatever that is? I just think maybe it could have some attention. Not sure.
I have to leave that to the powers that be to make those
We
sorts
will,
of decisions.
but we'll send it up the flagpole.
Sure.
Okay, deeming.
Yep.
I think the way I want to enter this camping ground is when someone applies for the age pension, there's two tests. There's an income test, which how much are you generating from investment assets, from working if you're still working, or maybe deeming, but we'll leave that there for now, or the asset test. How much, you might have a commercial factory bay worth $50 million, but it's empty and it's just there because you want to give it to the next generation, but it doesn't produce an income. What test, with the income and asset test or the formula, we have a look at the result of plugging both into the system, and is the pension awarded on the least generous or the most generous outcome based on the two tests, and can they both be used?
They both have to be used. So, the way that it works is we look at what your assessable income is, and assessable income is different sources of income are assessed differently. So gross wages versus potential profit from something like an investment property or self-employment.
Oh, I'm just going to jump in there that I forgot to add. When we were talking before with the work test and the income thresholds and the bank and all that, you can't use investment income in that bank.
No. For the work bonus, that's why I've kept it's wages or eligible self-employment. And when I say eligible self-employment, if you're, for whatever reason, maybe tinkling with shares and claiming to be self-employed, might not meet the requirements.
Yes.
Running my shop or running a business, then absolutely meet that requirement. Does not apply to investment income, doesn't apply to any other source of income, compensation income, pensions from overseas. None of those attract the work bonus. It's just wages or eligible self-employment. So yes, thank you for that. You lodge an application for the pension. We look at the total value of your assets. We look at how much assessable income you've got. We then work out whichever one is going to pay you the least rate of pension, and that's the one that you're going to be using. And you've got to be eligible under both tests to be able to get paid. So in your scenario, I may be eligible for the full rate of pension because I've got no income, but no pension because I've got massive assets. Then the pension rate would be zero. And I'd be saying you'd absolutely want to apply for a Commonwealth Seniors Health Card, or how are you surviving? You might need to really look at restructuring whatever it is you're doing. So whichever one pays you the least is the one that we use. You've got to be under both tests in order to be able to get payment. One of the biggest sources of income that people need to understand is this idea of deeming. And deeming is when we take what we call a financial asset. So by financial assets, I'm talking about bank accounts, shares, managed funds, loans that you have made to other people, those excess gifts that we were talking about over the 10,000 to 30,000 over 5 years, most account-based pensions, and superannuation for people who are over age pension age as a pretty standard list. And what we do with those is we add them all together. So we just give the total of what they all are and we come up with a mass figure, and then we apply our deeming rates. So we decree or declare or deem that these investments are generating a fixed rate of return regardless of the interest that you are actually receiving or the drawdown that you are actually taking. And the fixed rate of return at the moment is 0.25% for the first fixed amount and then 2.25% for everything over that. And the fixed amount is set on whether you are a single person or a member of a couple. And if you're a single person, it's 64,200 at 0.25% for the total balance, and then 2.25 for everything over that. For a member of a couple, it is 106,200.
Now, just while you were talking there, you saw me tapping and crunching. I'll just assume a single person has a $5 million warehouse.
Sure.
And we won't use 50 million, we'll use 5 million. The deeming rate basically on that first 64,200 and the balance of 4.935 whatever, Centrelink are going to say for the income test, that asset, we're assuming that it generates $111,000 worth of income, the deemed amount, even though it's not, there's no tenant in there and it's just sitting there.
Yeah, so you're wrong in that we would not deem a warehouse. So a warehouse or investment property is not what we would call a deemed financial asset. Everything's complicated.
Yeah, sorry.
Only time, so if I had a $505 million bank account, then yes, that's
sorry.
for that.
Or an equity portfolio.
Yes.
Sorry.
To clarify, we could do it if the warehouse was owned by a self-managed super fund.
Yeah, but then it's a super asset.
Yes, and that's why we would do it, not for an investment property itself. But if I had an investment property or I had a holiday home, so we'll use a holiday home as an example because that's a good one.
$5 million holiday home.
No income coming from it.
Yep.
It is just an asset. It's a non-income generating asset. There'll be no deeming from that. We'll acknowledge that the balance from that one is zero. If I had an investment property, we'll allow for the deductions that most of the things that the ATO takes off, we take off. So your rates, your bills, all the sorts of things that you're charging for the cost of running the accountant's fees, all the things that you're doing to reduce your taxable income. Most of those will also accept to reduce that. So we're looking at the profit from an investment property or a warehouse.
Yeah, and I think it's probably, I'm just not in this enough, but I like to use property without a tenant for examples because it gets people the practical.
Yep.
However, if it was $5 million in cash.
Yes.
At a 4 and whatever % interest, in real money, it would produce $225,000, but Centrelink will deem it as 111. Right. Does that then? So does the real money then tick over and come online as part of the income test or not at all?
Never. Well, I mean, the person wouldn't be eligible because the asset is too high.
Exactly.
But apart from that, so we said that the asset cutoff point for a member of a couple, or we'll stay with a single person, is $704,000. So if I had total financial assets and then my only assets, and there was $700,000 worth, so I still had some small pension eligibility. Yes, at 4%, that's what, $28,000 worth of income?
Yeah.
4 sevens are 28.
What's the limit? 760, did you say?
The cutoff point for $704,500.
$704,500 times 4%. Yeah, 28,180.
Okay, so the deemed interest on that would be nowhere near that figure.
No.
And we would never look at the $28,000. We just won't look at it. A better way to talk about it is your account-based pension. So if $700,000 in an account-based pension with a minimum drawdown of 5%, that's $35,000 worth of income. We're not going to look at $35,000 worth of income. We're going to deem it at our deeming rate. If you chose to draw down more, you chose to draw down 8% because you're within your rights to do that, we're still only going to be deeming it at 2.25% as a maximum.
Now, these rates were changed during COVID and they're
frozen.
They're frozen until 26?
Yeah, that's right. So they were frozen until the 1st of July 2025, but that's been extended now to the 1st of July, or 30th of June, I should say, 2026. Yeah. So it's going to be staying at 0.25% and 2.25% for that period of time. So
pensioners, you're going to make some extra money in the next 12 months?
Well, this is some of the things that I really like about deeming. It's it's a universal leveler is the best way to describe it. So when it comes to looking at my retirement and investing for my retirement, in the past, I would be looking at investment options that could potentially improve the rate of pension that I'm getting. And so I'd invest for the pension. Deeming makes that pretty much pointless because if my bank account plus the cash that I've got hidden in the mattress plus my superannuation plus my share portfolio are all treated by Services Australia exactly the same way, then there's no motivation from a pension perspective to put the money in the bank account or the share portfolio or the super fund into an account-based
pension. Do what you want.
Now you focus on the purpose of the investments themselves, which, as any financial planner should be saying, is your overall motivation. Why would I choose super over a bank account? Why would I choose a share portfolio over an account-based pension? Let's look at the investments and what's good about them and what do they provide and how can they be useful for me, not let's look at what they can mean for my pension. So it's a universal leveler, and I think that's a fantastic aspect.
Yeah.
It also means that I need to tell you about all the time my income changes because we don't care about when your income changes. When you lodge an application for the
unless it's a earned income from work.
Then we absolutely care about it. That's right. Very good. Thank you. So when you lodge an application for the pension, you're going to notice that we don't ask for the interest rate on your term deposits.
No, because you don't care.
We don't care. We deem it at our 0.25% and our 2.25%. So we don't look at those individual details. So your reporting from that perspective is significantly easier.
With these rates, they were halved at COVID, weren't they?
They've flown up and down. They've grown and they've shrunk. It's when the financial crisis hit, because normally if they're going to change, they'll change on the 20th of March and 20th of September.
Yeah,
that's just a custom. It's not a requirement. And when the global financial crisis hit and everything was falling down, the deeming rates actually were dropping almost on a monthly basis for a while there.
Yeah.
And then they started going up again when the market's gone up. The market has been going up. Interest rates have been improving, but the deeming rates haven't changed. Again, that's just the rules that both the governments have put in place.
Okay, an interesting point here. We need to update Your Majesty within 14 days of changes. What about if our investments increase or decrease? Is there an amount that we need to tell you?
So with financial assets, we're meant to be told if your financial assets increase by go up by $2,000 or more. You don't really have to tell us if they go down, but if you're a part rate pensioner, you may want to tell us if they go down.
Because that could increase the
rate of pension. Now, there is a big proviso on that one. That doesn't include shares. So not shares owned through a self-managed super fund, but shares that are owned directly.
Or a retail super fund.
Yeah, any super funds.
Yeah, super environment.
Yes, any shares that are you're right. Any shares that are in a superannuation environment, they're covered under the balance of the superannuation fund. Shares that are owned directly are a different story. So Services Australia acknowledges the volatility of shares, and they acknowledge that, if I'm supposed to tell you changes in the value of my shares, when do I tell you? At what point did they go up?
Thursday morning?
Or 20 minutes from now when they've changed again. So what we do is that we actually, once you're on the payment, we set the value of your shares on the 20th of March and the 20th of September. And we basically say that's what we're going to accept the value of your shares are going to be for that 6-month period, and we will revalue them on the 20th of March and 20th September. So you don't have to tell us of changes of the value of your shares. We will take care of that automatically. You can choose to tell us again if the shares reduce in value, but it's really important to say that we don't just revalue one, we revalue all. So if one of your shares have fallen in value but the other 4 have gone up, you might not want to actually have that conversation because you could be in a worse position because they've gone down. You don't have to tell us about change of the value. You do have to tell us about change in the number of your shares. So buying any, selling any, getting some given to you through a dividend reinvestment scheme, they are all what we would call a notifiable event. You need to tell us within 14 days of that happening. So unless you're buying and selling or unless you've been given some, you can just sit and leave your shares go and we'll take care of it. The other one is property. So with investment properties or holiday homes, we first of all don't expect you to value that. We don't want you to go out and pay for a valuation. We take care of that valuation ourselves, set it from the date that your pension is granted. We will then
Can I challenge the valuation if I think?
Absolutely, you can. So it's an independent valuation. We've got a third party that does it, but
and that would be akin to just a desktop val that brokers use and all that stuff.
Yes.
Yeah.
They will inspect the property if you challenge the value of the property. So if they don't know it was Auntie Mavis's old place and she hasn't looked after it for ages and you risk going through
it's
the
actually
floor.
not worth $2 million. It's worth about $100,000 because it's a dump.
Have you seen this place? Yeah. I mean, you will give us on the application details of the property to give us an idea of why it might be not worth that. But if you think we're right off base, then you can absolutely challenge that. But assuming that we're pretty close, on the anniversary of you claiming payments, we will then automatically revalue that property. So again, my property was worth $400,000. It's now worth $420,000. At what date did that $20,000 increase happen? There's no date. So unless I've actively gone in and put money into it to cause some changes, I put a swimming pool in, we've done something significant that's increased the value, there's nothing to tell. Services Australia will just revalue the property on the anniversary of you applying for payment. So again, yes, we're talking about changes of your assets, property and shares, we will take care of automatically unless you're actively doing something in them. The other one, just as an aside, that people often make mistakes on is valuing your household contents and personal effects and depreciating your car. We don't depreciate.
Okay.
So if the car is, it was worth $20,000 when you bought it, you turn the ignition, it's now worth $15,000 because that's just the way the market works. When you're reporting the pension, the value of the car is $15,000, not the $20,000 it's insured for. It's whatever you get on the market. If 2 years later it's now worth $12,000, you need to tell us it's now worth $12,000.
Is there a threshold that I can have up to X personal assets that isn't part of the asset test?
No, it'll all be part of the assets test. It just means that not very much. And that's the other point. When it comes to household contents and personal effects, we are again looking at what you would get if you put it on the market. So realistically, it's garage sale value.
Yeah.
Life on the lawn sort of concept. My entire CD collection is worth $10.
You wish.
Yeah, that's right. My 1970 Mission Brown Wickerworks couch is worth $15 if I'm lucky. It's that sort of value.
Yeah.
But we don't want you to put a lot of thought into that. I had a gentleman who came once and he had 4 or 5 pages where he had actually gone through and valued everything in his house as realistically as he could.
Well, you get that with a retired engineer, I guess.
As I said, it's one of the most beautiful and pointless documents I've ever seen because he could have just said it's $5,000 and we would have gone, fine, we accept that.
Knock yourself out.
We won't challenge it, but sometimes we will ask the question because people overvalue.
Yeah, it's just to please explain.
Yeah, I actually had a customer who wasn't eligible because they said their household contents and personal effects was they were close under their other assets and the home contents pushed them over because they said it was $70,000 because that's what it was insured for. I said, so if you actually tried to sell that today, what do you reckon you get? She said, $6,000 if I'm lucky. That's the figure that we want. You're now under the cutoff point. You can now apply for a payment. Not because she did anything wrong, but she just didn't accurately value.
Yeah, overcooked it.
Yeah, what the household contents was worth.
Okay, moving along. We've got 10 minutes. Travel.
All right.
Can I retire in Australia, get a full pension and go live in Bali?
You can, but it won't be the full pension, but it'll be very, very close.
Right.
So the rules, and this is very important it's only age pension we're talking about here. Different payments have different rules for going overseas. For the age pension, if you are temporarily going overseas, the first 6 weeks, there'll be no change to your pension rate. Everything stays exactly as it is. In fact, if you're going overseas for 6 weeks or less, you don't even need to let us know about it.
Little worldwide trip.
Yep, and you're back within 6 weeks, it's all fine. After 6 weeks, your pension concession card is cancelled. You can reapply for it when you get back if you're eligible, but you lose it after 6 weeks if you're travelling overseas. What happens is that your pension rate then reduces as you lose some of the supplements that you get with the pension. So you'll notice there'll be a drop in your pension rate from 6 to 26 weeks.
So some of the supplements, is that like a rent assistance?
No, rent assistance is a different rule. So every fortnight pension that you get, you're going to see that there's a figure in your bank account.
Yeah.
That figure is actually made up of mostly age pension, but also supplements.
What are some of the supplements?
Well, they're down to some
creatine shakes, whey shots or something.
In the past, they used to actually list them individually. There were things like telephone allowance, and there was an internet supplement.
Just ancillary stuff.
Pharmaceutical benefits supplement, that's what they've all lumped it together. There's the senior supplement and then electricity supplement, I think they're called. Now, some of them are not payable when you're overseas. So it goes back down to the basic rate. It's automatic.
Yep.
You just notice that there's a reduction in your pension rate. And it stays at that rate for 26 weeks, from 6 to 26 weeks. And it's only at 26 weeks onwards that things get a little bit more complicated. So at that point, if you're still overseas, we're going to look at what's called your Australian working life residence.
Ooh, sounds sexy.
It's how long you've lived in Australia between the ages of 16 and age pension age. And if you've lived here for 35 years or more, then your pension rate won't change. You'll continue to get the same rate that you're getting beforehand, and it'll just keep going through until you return to the country.
But so it's the rack rate, not the supplements.
Yes, the supplements have stopped.
Yes.
Yeah, so they stay off and they won't come back until you return to Australia. If you leave Australia permanently, the Australian working life residence comes into play immediately. So instead of the 26 weeks, we look at how long you've lived in Australia between 16 and 65. We then work out what that rate will be and we'll pay you that rate. And it could be that you live in Bali for the rest of your life. And because you were in Australia for more than 35 years, you get the majority of your age pension, the supplements, and that just keeps paying for you indefinitely while you're overseas. If you've been in Australia for less than 35 years between the ages of 16 and age pension age, then whatever proportion you've been here is the proportion of pension you're going to get.
Right.
So if I've been here for 10 years out of 35, and I love this because it's horrendous maths to say, then I will get 10/35 of the age pension being paid to me. And I'll get that for the rest of the time that I'm away. However, that's the pension portability rules. The income and assets test is always in play. Remember that. And the big one here is the family home, because you're only allowed to be absent from the family home for 12 months before we count it as an investment property. We make you a non-homeowner and treat the family home as an investment property.
Just on that, for everyone playing at home, that is different than the ATO 6-year rule.
These are Services Australia. So whose door have you gone through? You've gone through the door of Services Australia. These are Services Australia's rules. So with the travelling long-term overseas, at 12 months away, forgetting the portability rules, we're going to be looking at your family home and we're going to look at are we going to be counting that? So keep in mind the income and assets test at all times. You might meet the portability requirements, but if the family home comes into play, that could have a significant impact on your pension rate while you're away.
Yeah, and I think that's a good myth, because from summarising what I'm hearing from you, you can live in Bali from age 67 to 75 and continue to receive the age pension, but after 12 months, your family home's coming online, it will probably knock you off the pension anyway, and you'll have to eat that.
Yes, very possible.
Now, if you've always been a renter and you don't have any money, and the only money you've got in the world is the fortnightly amount that's coming to Centrelink, you could live in Bali forevermore, amen, and have a great quality of life.
I had a customer who renting inner city, loved living in the inner city, but knew he could, even with a very decent superannuation fund, he knew he could never afford to buy in the inner city. And so he moved to Sri Lanka. And he could buy a very decent home in Sri Lanka for very little usage of his super, still have a pension eligibility because his family home is exempt, and still have access to his super at the same time. And so his pension was being paid for the rest of his life, had somewhere to live, and had superannuation to play with at the same time. Yep, works fine for him.
But this actually goes back to one of my key tenets in money. We don't make plans on how do we pay the least amount of tax, or we don't make plans on how do we get the maximum pension. We make plans, what do we want to do with our life? We move in that direction and let the cards fall where they may and plug the money into our life plans.
Yep.
If you wanted to live in Bali forevermore, amen, sell your house, invest the money, live off the returns, you're all good. It's pretty simple because you want to live there for whatever reason.
Yep. Live the lifestyle that you're after. That's all about living the lifestyle.
Then if you want to come back to Australia and buy a cheaper downsized house and you move that money back into a house that you live in, so you've sold the $2 million house, you've lived in Bali for 10 years, lived off your own savings, moved back to Australia, you got $1 million left, buy a house with $1 million, then you get your full pension again. Like, it's not rocket science.
Yep.
Or brain surgery or rocket surgery.
It's the one.
Look, speak to an FIS phys officer if you want some clarity on that.
Certainly if you were thinking of permanently moving overseas, have a chat with us because it's the family home and the implications for the family home, which you might not have been thinking about.
And just in finishing, any comments on super and working with the pension?
Yeah, so very quickly, superannuation for people that are underage pension age is an exempt asset. We've basically touched on this one already. When you turn age pension age, your super is going to be counted as a deemed financial asset, whether you choose to move it into an income stream or not. So it is going to count. Because, again, basic premise, because we treat account-based pensions, income streams and bank accounts exactly the same, at that point, how you choose to spend the money is really up to you. Just let us know what the consequences are, but know that it will count. We're going to count that. If your partner is underage pension age and they keep their super in accumulation, which is the important part. When we talk about super, this is super in accumulation where it's growing and you're not touching it, paying tax on the interest of 15% and it's accepting contributions. That's the exempt asset. Super that's in payment mode through whether you're self-managed super fund or account-based pension, that's accessible at any age.
However, the income is tax-free.
Well, yes, depending on your age, but yes. From a tax perspective, that's all fine. If my partner was 60 years of age and they chose to move their super into an account-based pension and I'm 67, their super is moving from an exempt asset to an accessible asset. It will affect my rate of pension. So that's a conversation you do need to take into account.
And this is the dance, like when we've got age pension on the table, we've got probably, I would say, and push back on this if it's wrong or you can think of anything else, there might be 4 or 5 plates spinning. We've got the first plate, which is the Service Australia age pension rules and guidelines. That's one plate that's spinning. We've got a tax plate that could be spinning. We've got an estate planning plate that could be spinning, where we might not want to move money from an older spouse's super to a younger spouse's to get more Centrelink because it's going to impact the estate planning and whatnot. And then probably all those plates sit on the big plate, call it a lazy Susan if you will, that is your lifestyle and financial goals.
Add potential aged care issues on top of that as another one to go with, and then you're absolutely right.
So it's the thing that I want to kind of finish on is you've got to look at everything and how it works together.
Yes, absolutely. The goal is the lifestyle, which we've talked about many times, and that lifestyle involves a lot of different implications. And what's right for your mate is not what's right for you. So it's all individual. It's the way it's designed to be. It's the way the whole 3-pillar policy from the pensions that we talked about in the first episode is designed, your personal circumstances. And if there's a pension eligibility in there, we will be the first people that would say this is how you apply. Because if you're eligible, then get the payments you're eligible for. It's under the law. It's what is expected within Australia. The concern comes to try and manufacture an eligibility and the potential in longer-term implications that could mean for you, for your future. But again, if you talk to your professionals, speak to the Financial Information Service on 132300. Money Smart website, which we haven't mentioned, Money Smart you should always mention. moneysmart.gov.au is a great source of online information for you.
Except the odd error that I see. But anyway, proceed.
We won't mention that part. And then also, again, Services Australia's website, servicesaustralia.gov.au. So lots of resources out there for you, all with the purpose of trying to get the best out of what you've got to live the lifestyle you want. Mm-hmm. And if that means that you work a little bit longer, then all right, you work a little bit longer. But again, that doesn't mean we can't help you. It doesn't mean that there's no support available just because you choose to work longer than being 67 years of age.
Yeah.
So check the resources that are out, the support that's out there. There's a lot more than you might think.
Awesome. Well, Justin, you have been fantastic. I have been Glen. And what I probably will say is what I might do, and we can talk a bit further offline, maybe we need to get you back here every 4 months or every 3 months or so, and we just answer listener questions and
love to
real life scenarios.
Yep.
And because I just think I've learned a lot, our listeners have learned a lot in these 2 episodes. It is a complex system. The more time you have to plan and get your head around stuff, the easier it is. Live your life, plug your money into your goals, let the cards fall where they may, because I'm certainly not going to not work if I can, where, so what? You might eventually lose $20 a fortnight in pension. You've made $100 more and you've had an active life and you commit, Yep.
And we talked about the fact that, you gave the example, $5,000 more with no change on the pension and no change on my tax.
Yeah. What's the problem?
Yeah.
Love it. Justin Bott, the Community Information Officer, the CIO. Thank you so much for coming on Retire Right. We'll see you soon.
Been an absolute pleasure. Thanks so much.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the Product Disclosure Statement, PDS, and Target Market Determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive, Pty Ltd, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds Financial Services Licence 451289. Martin McGrath, Financial Edge Group, and its employed financial advisors are authorised representatives of Synchron Advice, AFSL 243313. Opinions or comments from any guest on the podcast are theirs, and not those of the hosts, the publisher, or their respective licence holders.